Hi, Ryan. It's Grant Abbott speaking. Thank you very much for coming to this session. It's one I really didn't want to. I really didn't want to think that I had to do at any point in time, but suddenly I got a bit of a wind. In fact, I think it might have been Phil Scandizo sent me a link that Bosanac case was out. It came out on the last day of August, the 31st of August, and really there was a bit of commentary coming out in September. Phil, again, thank you very much. I think it was Phil that gave me the links to the case. I read the case. It's only 14 pages long, which is extremely rare for a full federal court decision. So the only one above the federal court is, of course, the High Court. And it's very unlikely, if you've heard me talk about this before, the Change GPS estate planning week, that it will end up going to the High Court, because the full federal court was very smart in its interpretation by relying on a lot of High Court cases. So it deals a lot with the equity law and really focuses in on a lot of information. I'll go through the facts. I'll go through some of the salient issues that came to High Court, the main problem, and more importantly, we'll look at how to fix it up or what to do now. Again, if you've got any questions, please put them in the Q&A, and let's get on. So there's a bit of disclaimer there. So this is general information, but it's really, I don't even know why we put that in half the time. Don't forget Tanamoulis at abbott-family.com.au is our Abbott-Family side. You'll see one of the solutions is obviously going to be engaging Abbott-Family. It's not an expensive process, but we'll let you know about that a little bit later on. I just want to put these up front, a couple of upcomings. On the 2nd of December in Brisbane, 3rd December in Gold Coast, we've got our strategy breakfast session. So it's myself and a few of other speakers. We've got Ash, we've got Michael, hopefully we've got Tim Munro might be doing a bit of a cameo because he's brilliant at doing that sort of stuff. Ben Gill, our sales director, and we'll be going through the new Lightyear Docs 2. And I've got my top 10 strategies for 2022. So if you can come along to that, that'd be absolutely fantastic on the day. We are looking at doing one later in December for a live streaming there. The Lightyear Docs 2 system will be up and running next week, so it's very exciting. Now, another one that I'm really excited about is on the 2nd December at 12:30. I've given you the link. You can see that inside the chat if you haven't got it yet. Is that we are having a launch of the new SAPEPA site and also the membership options. There's 3 membership options. If you've gone through the accreditation process, on that day, you'll be able to pick and choose one of the membership options. There's a couple there. There's a foundation membership, which I'm already on number 1 foundation member and paid my dues the other week, as did Tim. And we've got an ordinary membership, which is over time is a bit more expensive. But we'll cover that next week. There's some great opportunities. One of the big things that you'll see there is, particularly for foundation members, you will be given your own dedicated marketing page on the site. So one of the big areas for us with SAPEPA and all the board, which is Sally Rorke, Susanna Bransgrove, myself, Tim Munro, Michael Jeffries, and also Ash, is we wanted this to be a front-facing website. So it's there to enhance our advisors, so people can engage advisors directly. So we want to be that pinnacle, that tip of the spear when it comes around to succession, asset protection, estate planning. So there's a lot of goodies behind the back end, forums, study, education, resources and all that. But the main thing is that tip of the spear is going to be there to provide information for individuals who really are exposed from an asset protection point of view. There's more than 12 million people, in fact, probably about 15 to 16 with homes who are exposed. So we'll be looking at that 2nd December. Have a look, sign up for that one. And then we've got our accreditation course. So the accreditation course at this stage, Light Year Docs or Light Year Training Group is the only one offering that. But over time, there will be other institutions like Kaplan and some of the universities who we've reached out. Again, SAPEPA is quite independent from Light Year Docs, reached out and they provided them with the ongoing educational standards for them to develop their own courses. But if you've done the 3-day course, you've done the accreditation, you then become a member, you'll get your little certificate and you'll be a certified succession, asset protection and estate planning advisor. So it's very exciting. So make sure you lock on the day. I just thought I'd put that up front. Okay, let's get down to the issues at hand. So we've all heard this before. And look, you know, I've seen this. Many of you have seen this as well. This is pretty stock standard asset protection until the 1st of September 2021. But typically it's important to be able to identify which individuals or entities are considered high risk. So that could be the trading companies, trading trusts, individuals, professionals, etc. All of us would obviously, in the industry we're working, we're all high risk and are hence more likely to be at the mercy of creditors and litigators in difficult times. And which ones are low risk? Upon making this risk assessment, ideally the high risk individuals or entities are divested of any valuable assets, so to try and keep them out of the creditor's reach. In turn, the group's low risk individuals or entities would be best to hold these assets. In the end, if the high risk individual or entity is pursued by creditors, then further losses may be kept to a minimum where the individual entity does not actually have any assets for the taking. So that's our key goal. And we're just talking, they're talking about creditors here. I'm talking about litigation. For example, in the Bosanac case, there's 9 cases from the tax office against Mr Bosanac. So obviously he's got a, you know, he's got quite a big litigation team there and can afford it. This is one case that came out of it where the commissioner sought to recover quite substantial tax liabilities. And of course, Mr Bosanac believed that he had become, again, through this paragraph here, that he was obviously the high risk and he'd managed the risk there with the having the assets or having an asset being the $4.5 million home in his wife's name. A couple of asides there, we're going to have a look at the case. One of the interesting ones is that, again, putting an asset in the spouse's name is great, potentially, if we do it properly. But again, with Mr Bosanac here, quite often when clients, businesses fail, there ends up being a divorce. So in this instance, Ms Bosanac, she doesn't go Mrs, she's Ms Bosanac, ended up with the whole house. And now the commissioner's got the ability to come in and obviously weigh into that house because the full federal court held that 50% of the house was actually held by Mrs Bosanac. I'll just jump to Mrs if that's okay, so that there's a delineation. So the 50% of the house held by Mrs Bosanac was actually held on trust for Mr Bosanac, enabling the tax office to move on that particular house. And again, remember the asset protection. We've been through this many times before. Have a look at the video and also the booklet there as well around the protector, which is obviously going to be one solution I'll be looking at a little bit later on. But essentially in that regard, we've got litigation, which is the big issue. Creditors we've seen there. Obviously, creditors are an issue at any point in time, and we've got to be careful around the bankruptcy laws and particularly the clawback in Section 120, the 4-year clawback. If the accountant's given a solvency certificate up front, we'll talk about that a little bit later on. But family law is an issue, as we saw in the Bosanac case, which was another sideline of the individual. And what we're really finding now at Abbott-Family and Light Year Docs, and I know many of you are doing that, and for example, Mitch, etc. One of the big issues is obviously the great concern that our clients have got that their assets in the event of their passing will be going outside the bloodline. And that may well be the tennis coach or the swimming instructor or the youngest, younger next wife or whatever. So these are issues that have now come to the forefront, and particularly when we have a look at the last couple of years of COVID, which doesn't look as though it's going to go away anytime soon. If you have a look at countries who've been fully vaxxed in front of us, there's a good chance we're going to see a huge spike all across Australia for COVID probably in the next 3 or 4 months. It'll be interesting to see how the governments relate to that, or what they do. Are they going to lock things down like they are in Europe at the moment, where a lot of people have been not only double vaxxed but are now triple vaxxed? Or are they going to just let it spread like the US and also the UK? So that's not my issue. I mean, that's up for each state government. But certainly I can imagine that South Australia, West Australia and Queensland are going to be a bit of a shock being zero to suddenly having quite significant increases in the numbers. On that one itself is that, quite apart from that, I mean, you don't want to listen to me talk about COVID, but the key issue there is that front and centre mortality and also the incapacity is really a big issue there for the clients. So while it's there, it's a really good opportunity for us to engage. And again, you've heard me say that, and certainly Tim, that the best person dealing with all this asset protection is effectively the accountants and also financial planners. If we end up with this great position that you don't have any assets for the taking, then that protects us for litigation. May not work that well for family law if we've put our assets into a family protection trust, but certainly when it comes around to estate planning, with the potential exclusion of New South Wales, where they've got like a 3-year clawback, if you put assets into a structure with the intent to take it out of the estate, if you make that 3-year rule, and any other state, essentially, if you've got no assets, then your will is really not much use, which is good. I mean, that's the ideal that we want. And it's not only just our clients, it's also us. The problem, this is the case citation. I'll send that through to you. Look, I'd encourage you to read it. Honestly, it's not that hard. In fact, because it's only 14 pages. And this was on appeal from a federal court judge. The key issues are pretty quickly gone over. And you can see down here, the issue there is presumption of advancement. And you can see further where the presumption of advancement is qualified by statements of the trustees, etc., which is a High Court decision. So we've got Kenny Davison, Thorley JJ. So again, the only way we go up from here is the High Court. I haven't heard of an appeal, and Mr Bosanac is obviously, he's got a lot of litigation, lawyers and a lot of funding. He may well take it up, but look, I believe, having a read of this, I'm not sure the High Court will actually change its tune. I don't even think it would hold an appeal. So it looks as though the House is just up for grabs. Okay, so what are we going to look at? I'm going to look at who's impacted and why. We're going to look at the case just briefly. I'm not going to do a full read through there because, as I said, it can be encapsulated pretty quickly. And as it's only 14 pages long, it's really important for you to get on top of it yourself. I want to look at the methods of rectification and 2 solutions to tighten up. And then we'll have a look at some estate planning as well in relation to these issues. So this came straight out of the case. So what we've got here is the 3 judges in a unanimous decision. And I've pulled this out. It says basically the issue in this appeal is whether, contrary to the judgment of the primary judge, and I'll go through that anyway, Mr Bosanac held an equitable interest in residential property purchased for $4.5 million in the name of Mrs Bosanac only. The deposit of $250,000, the original deposit payment for the house, which was in Dalkeith in Western Australia, was paid with funds from a joint loan account. Mr and Mrs Bosanac then jointly borrowed $4.5 million from Westpac, and this was used to pay the balance of the purchase price. Now, the federal court judge in the first instance held that In fact, Mr Bosanac had gifted his interest or any entitlement to Mrs Bosanac. And as a consequence of that, the taxation office couldn't access those particular funds or that house. So that was quite an interesting decision, and probably many of us had a look at that and thought, well, yeah, that sounds right. That's why we're doing it. It's a gift. It's pretty obvious it's a gift. And they use an equitable resource, and they called it advancement. So advancement is, for example, if I say, look, here's a car for you to have, and particularly when we're having a look at, for example, children, if we give them a car, even though we might have no formal documentation, we can or they can rely on the concept of advancement under equity law to say it was really a gift and not a loan. So if we just go down here, so the issue in the Bosanac, and this is the first and most important, is that at the end of the day, there were no documents or evidence to show what was going on. And this is pretty typical. So we'll go down the track, and you can imagine the background and when they went back in 2014, they were buying a flash property in Dalkeith, which is lovely over there in Perth. It's on the Swan River, very flash. A $4.5 million house in those days. So it's probably up around about 9 to 12 by now, who knows. But again, obviously took the money out of the joint bank account, went to Westpac, and Westpac obviously is probably not going to lend to just Mrs Bosanac, because obviously Mr Bosanac had quite a few successful businesses, and so they did a joint loan. And obviously the advisors, and I can imagine they're pretty flash advisors if we're talking about the size and scale of his businesses, that they said, okay, we'll put it into the spouse's name for asset protection, which sounds good. I mean, obviously anyone who's an entrepreneur, and not even entrepreneur, but professional, engineer, accountant, finance professional, we've all gone down this track of putting assets in our spouse's names. Now, again, the issue there is, as I said before, it's great to have it in the spouse's name, but I would counsel you strongly that by doing so, quite apart from Bosanac that we're going to have a look at, is that it also opens up a bit of a wedge there anyway, in terms of opens up a bit of a wedge in case there is a family law issue. If you haven't got any assets in your own name, you're coming from a very weak negotiating position. Now with Bosanac, which is fantastic, all family court lawyers out there now, and I don't think they've really jumped on it, but if you're representing the at-risk spouse and then there is no documentation, then depending on the facts and circumstances, that you'll actually be able to claim that half the house is potentially the ownership of the at-risk spouse now. So what's been put in place really may well fall down. Now, like anything, everything's going to depend on the facts and circumstances of the case. But here, the key ones were, if you go and have a further read, it was the deposit from the joint bank account. It was also the property was in joint loans. They also used the property as security to buy other investment properties as well for the group. Now, when you don't have any documents or evidence, the issue goes to the court at first instance. And so in this one, if you have a look at the earlier decision, they went through all the facts of the case, where the money went, the flow of money, what was going on. And as I said before, the judge at first instance held that it was advancement. That is that it's an equitable principle that assumed there that Mr Bosanac intended for the gift to go over to Mrs Bosanac. So ideally, the smarter thing would have been to do a deed of gift right up front. And that would be useful. Probably there, though, if you do the deed of gift, then you've obviously got that 4-year clawback because it's a non-market value transaction. So we've just got to be really careful about that. but the fact that he put it in the spouse's name meant nothing anyway. So he wasn't really trying to get it. In the end result, it didn't work for him anyway. So it's best if you are doing this for a new client and you wanted to keep on doing this, which is not my preference, as I said before. If you want to keep on doing this, you'll need to make sure that you do a deed of gift at that point in time. So it goes to the spouse, any interest, and all we have to do is all legal and equitable interests in the property are to be gifted to the spouse. And you can do that through our deed of gift, which is on the Lightyear Docs site. Remember, Lightyear Docs 2 is launched next week. Now, the other side, so that was the argument there, and the tax office then came in and said, well, obviously, this is a huge issue for the tax office, because now they've got the opportunity of going out and pinging virtually everyone who's got the assets in the spouse's name. But it has a broader context because, again, all the areas that we look for asset protection, divorce, creditors, trustee and bankruptcy, and also obviously family provisions claims, now they're all open slather. So all of those lawyers will now, if they're smart, and this is going to take a while to wend its way through the legal profession, but it'll essentially mean if they find an asset that's in the spouse's name, then they're going to have a crack at it. So again, it's going to depend on what, if there's no documentation, the court is going to have to look at all the facts, all the circumstances, the witnesses. One of the big issues in this case, which the full federal court really had to go at, was that Mr Bosanac didn't actually testify in the case. So probably should have, but then again, I'd say it's probably going to be pretty incriminating there as well. And look, when you're up against the tax office, they have some pretty good senior counsel there. Now, the court ended up holding that instead there was a resulting trust. So the monies came from a joint account, there was a joint bank loan, and at the end of the day, and I'll take you through the court's decision in a sec, they held that they used another equitable principle, which was the resulting trust. There's Mr Munro, how are you?
Mr Abbott, how are you? So I'm late, everyone. I had one of those meetings that just went on forever.
I know, we all have those. It's just a matter, it's just one of the things. So I'm only just getting up to the advancement and also the resulting trust argument there. So the full federal court held there was a resulting trust. And essentially what they said there is, these are the last two paragraphs of the case. So as you get to see, there's only 28 paragraphs for a full federal court judgment. They were stamping their authority and just saying this is a laid down misère. And again, the only way it goes from the facts and circumstances of the first judge, it can only ever be appealed on law. So this is at this present point in time's law. So let's have a look at what they say. It says, it seems to us that ultimately the most significant fact in favour of the operation of the presumption of advancement in this case was simply that at the time of purchase, the Dalkeith property was put into Mrs Bosanac's name, notwithstanding that Mr Bosanac contributed half the purchase price. So again, there's an underlying assumption there that they're saying, well, that's how the first judge came up and said, well, it's advancement, so there's nothing else. This was, of course, sufficient to attract the presumption, absent rebutting evidence. So the presumption there is obviously the presumption of advancement. Now, for the reasons we have stated, we've concluded that in this case, the evidence and the facts as found by the primary judge based on that evidence rebutted the presumption. We infer from these facts that at the time of the purchase, Mr Bosanac and Ms Bosanac intended that Mr Bosanac would have a 50% beneficial interest in the property that was to be their matrimonial home. For the reasons stated, and they use that concept of resulting trust, for the reasons stated, we will allow the appeal and make the declaration sought by the appellant in his notice of appeal. So that is effectively the tax office got up and running. The parties will be given an opportunity to make submissions as to cost. So when we have a look at that, they're pretty cut and dried. And as there was no deed of gift, in my view, would have got around all of these issues. but they just went through. And as I said, Mr Bosanac didn't testify. So I think he probably would have said that it was not a gift at all. So if you have a look at that, the 50%, really the beneficial interest is held on residing trust by Mrs Bosanac for that. So we've just got to be really careful about that one. I mean, you've seen this because I remember Tim a number of times that issue of obviously the having the assets in the spouse's name, who we believed at that stage was the less risky person, would do the trick. I mean, you've been around a long time. Do you want to sort of, what say you on that?
Look, hi everyone. A lot of the people here are Change TPS members. It's nice to see so many of you along again today. For years, you would have heard me talk about, remember we drew on the whiteboard risk and assets, and we've got the risk taker, and we've got the asset holder, and the aim is to keep them separate. And I've always drawn the house on the asset side. I've put the spouse's name on top of the asset side. And look, most times we have clients when they come in and it might be held 50-50 or in all sorts of different ways. It's normally not where we want it to. Sometimes, if there's a husband and a wife, the husband might be a bit protective and has the house in his name anyway, which is bad news from asset protection. Yeah. So we always talk about keeping that separate. The thing here, though, with this case is, as with everything with law and tax, we've got to relook at situations all the time. One thing I've always said, and we've actually got that in, we had this actually, Grant, in the letter of advice for estate planning asset protection that we put out in September last year, that's available for GPS members. We actually said there in a paragraph, we said, look, if the house is in the spouse's name, that spouse has to earn enough after-tax income in their own name to make the home loan repayments and to make rates and all other house repayments. Because for years, there's been, now when I've been talking to liquidators, they've always said, well, whose funds have gone in to contribute towards the payments? So this is before this case, okay? Whose funds have contributed toward the payments for this? And if, say it's the husband, in this case, say the wife wasn't working and the husband was on $250,000 a year and paid everything, but the house is in the spouse's name. If I'm a liquidator, I'm attacking that because it's the husband's money that went into that. So I've always said for the last 15 years, if the house is in the spouse's name, the asset, that spouse needs to receive a trust distribution or a wage or whatever. So after tax, they have enough to cover all expenses. It is very hard then for anyone to argue, well, hang on, the husband has, there's this right to those assets when the wife has paid for everything. Now, the liquidator could say, oh, but she didn't have anything else. He paid for food and drink, but it's a harder argument to have then when it's proven it's come from her bank account. So it needs to be her account, money's gone in, she pays her own tax, she pays these expenses. Very difficult for that to be overturned.
I know, and it's sort of, well, obviously in this case, so even if you do go down the deed of gift, you may still be caught on the evidence of saying, well, hold on, that you're really, the money is in your name. You don't argue a sham. It's the deed of gift helps, certainly, but again, that flow of funds is a significant issue in that regard.
Yeah, definitely. And can I say, Grant, the whole thing with asset protection, I've spoken about this many times over the years. It's to put as many barriers up. Exactly. Nothing is 100% safe one way or another. And too many accounts get hung up. Oh, it's a 4-year clawback. Oh, but this could happen. Oh, but that could happen. Hello, turn your thinking around, accountants. Put as many barriers up there. Put as many walls. Use as many moats as you can. Then the other side has to spend big dollars to fight. If you've put all the defences up, the other side's got to spend the money, and 9 times out of 10 they won't. And even if they do, if you've done everything the way we're showing here, you've maximised your opportunities to, So don't think, oh, look, it could fall down. Think about, hey, this could cause the other side to walk away.
And you can see in this one, obviously the Commissioner, if he's running 9 cases against Mr Bosanac, he's got the funds to really attack him at every level, which is important. So now it's good when decisions come through like this, because it means from our perspective, at least we know we've got some good settled law. Now, things change. You know, what we've done in the past, and I know you've been very cautious, but what we've done in the past changes, and we need to keep up with those changes.
And there's nothing wrong with that. Like
No,
the other thing you see accountants get maybe a bit, and everyone online here, I know you're not the way of thinking, but they sometimes think, oh, I can't go back to the client about this. I feel bad because I advised them differently 10 years ago, and the client's going to get upset. Hello. No, everything changes. We get a new mobile phone every 12 months. We update our computer every 12. Everything is changing all the time. So that's why we've got, and GPS members you see in the VPP email we released about this, we explain that. So just use that and it works.
Do you have that email there at all? Or?
Yeah, look, I'll pop it up. There's just a question there for Paul Hopkins, if I can answer that. He said, Tim, if the spouse is in the house's name, if the house is in the spouse's name and they receive a distribution from the trading trust to cover everything, but they don't work in the trading trust, how would that be viewed? I think whether they work in the trading trust or not is irrelevant. If they receive a distribution of funds, they can use that distribution any way they want.
Yeah.
So it's just they need to have an income. They need to have funds from somewhere to make those repayments. Let's twist that around a bit. Let's say that the spouse has $1 million in their name from an inheritance, or they've got some cash there. As long as they use their cash to make those repayments, that's fine. So they just need to use after-tax money that they've received or earned, or other funds that they've got in their name to make those payments. We don't want the payments in any way coming from the spouse who is the risky person.
Do you see the Commissioner getting pretty aggressive on this? Because I think it's sort of opened the floodgates for the Commissioner there.
Look, if there's money to be received, I mean, let's put ourselves in that position. If there's money to be received, any of us would go after it for the Commissioner, wouldn't we? 100%, they'd be going after it. So that's why I think it's such a big thing to look at. And look, there's a lot of people where they've tried to do, they've been a bit smart and done the wrong thing and not paid tax. And I don't like paying tax any more than anyone else does. But given that I have to, it really ticks me off that I see some people, just avoiding it and just thinking they can, just not deal with it. Like I want a fair playing field. So I think it's wrong that these people get away with it. So, yeah.
And I had a look at, if you want to just get your letter up, it'd be great, Tim, just to show everyone. I've got a good analysis here from Jeff Wayne, is when you do go through the whole judgment, as I said, it's only 28 paragraphs and they're not big. So the presumption of advancement was the first issue because it was in Mrs Bosanac's name. So that's a good one. But again, when you go through, they raise a few high court cases around how to rebut that advancement, and which effectively they did based on the facts that were of the case. So I think it's a pretty good position. So have you got it up, Tim, or should I stop?
I'm just putting it up now. I'm not going to show all of it because you've got to be a GPS member to get all the good stuff. Here we go. I'm just going to share my screen. Okay, can you see that?
Yep, you're up and running.
Fantastic. So as usual with VPP, it's value, plan, price. If you outline it in that way, you'll find probably 9 times out of 10 at least the client just goes, yes, let's do it. So urgent action required. Your family home may be at risk due to a recent court case. For many years, our advice to all our clients involved with the business has been put ownership of your family home in a non-working, non-risky spouse partner's name. However, a recent court case a few months ago has changed the law significantly. Your family home may now be at risk. This email is to explain in more detail how we can help you and why you'll be better off with our recommendations. So this is it. This is the key thing we're talking about here, Grant. Laws change all the time, and it's our role as your accountants and advisors to keep you alert to important changes. We outline, there's some of the credibility, we put the name of the case and everything, and we didn't go into massive detail because clients have got a tiny attention span. We go into detail as accountants and advisors. So we want to help you protect your family home, and we have developed a number of strategies to deal with this. These strategies, and this is where the value is, you put in the amount that their family home or the equity is, that's what you're doing. Then we outline the plan. So GPS members, you get that. And then the price, I always outline, we're very busy at the moment, but it's an absolute priority for us to assist you. Our letter of advice for this might be $1,000 plus GST. Now you equate the price back to the value. This is a small amount to pay to ensure the equity in your home of $500,000 is properly protected. We then go through the next steps and go from there. So it's really simple and straightforward, but it just confirms everything they need. It helps the clients to understand the value that you're creating for them, the plan and the price. And you're not apologising for the change in the law, you're alerting to them. That's what you need to do as accountants, alert them to important changes and give them an offer to fix things up.
So for the manager just came through and said in the change GPS package, where do they find that letter?
Okay, let me have a look here, Manish. I will show you. If you've looked on the dashboard for change GPS, it gets highlighted up there. So can you see this, Grant? I'm just going to change GPS now. Yep. Okay, I'm going to log in. Now with change GPS, recent updates, look at this here, because see, that was fourth most recent document, urgent review of home ownership asset protection. There's a link straight into it. There's an asset protection estate planning offer email, director's ID registration email, whole range of things. So you can go straight to the link. So get used to looking in there. Alternatively, you go straight into it by going into core and resources. Now in resources, we have a whole range of VPP emails, business structure advice, the overall framework one, tax strategy meetings, all the rest of it. But if you go in here to client emails, we've got here director ID, estate planning, asset protection, a few things here, other asset protection ones. And then go through to asset protection and estate planning, VPP email, urgent review of home ownership asset protection. That's where you'll find it.
And look, I think, again, just going through and you know, all of us need to be in a position of being on the front foot here, particularly when things change. One of the other ones that we have a look at is obviously successor director. I mean, many of us have got that position that we don't have that successor director solution. So things change, and it's a great opportunity to get in front of this with the clients because, you know, this is, I mean, this is a case that's only, you know, weeks old we're talking about. Yeah. So you're going to be well and truly in front of every other accountant. Okay, so there's a couple of solutions that are available, and I'm going to go through both of them, and then I'll have a chat with Tim on it. The first one is to go back and do a deed of rectification and a deed of gift. So in the past, and for those of you who've been dealing with banks and stuff like that, particularly around the lending, quite often they'll go through a fine-tooth comb with all the trust documents or the SMSF documents and minutes and corporate trustees, and you know, they're charging $2,000 to $3,000 to find something, which is fantastic. If they find something, then what they'll do is you need to do either a deed of rectification, which is fixing something up, a deed of ratification, saying this was what it was, or deed of confirmation. So probably in this one, maybe rather than do a deed of rectification, we'd probably end up doing a deed of ratification or deed of confirmation with a deed of gift, basically saying that essentially the advancement, or sorry, just going down the fact that there's an advancement there. Now for that one, Abbott Morley will be something we're not going to put up on the LYD package because it's probably got a bit of weight to it. You need to have properly documented arguments. So we'll be providing a letter of advice, a deed of ratification and confirmation, along with a deed of gift, which would then be signed. So we're working out the pricing on that, but that'll be one option there to fix things up. Solution two is obviously to go through and do the protector, which is probably my preferred one. It's one that you guys can take on straight away. Is obviously if the house is in the full in the spouse's name, the best thing to do is then do a if you're doing the protector, to do a deed. So it's a joint gift, because at the moment we don't know whether it's the spouses or it's the husband. So it's best just to say, okay, well, we're going to put the whole, in this instance, the whole $1 million in there, even though it's owned jointly, because we don't know which one's going to be attacked, but we're going to get it both off the plates of both of them. Now, when you come round to doing the loan, I'll have a chat with Tim in a second, then I want to come back to this equitable stuff and some more of my thinking around this family protection trust. I just want to float past all of you because you're all super smart. But when you come back and do the loan would go back to effectively both parties jointly. But when you come around to registering the mortgage deed, it's only in the name, obviously, of the spouse. So once we do this, I mean, if you're going down this track anyway, this covers us from that estate planning. Obviously, family law, because it's only just being done, there's not an issue there. The gifting, again, you've got that 4-year clawback, but as Tim says, and most insolvency practitioners, once you get it up and running, and you've got a solvency certificate, they don't really go back to unwind the transactions because it's a very difficult process to do. So they'll come around to the negotiating table. And the further you get onto that 4-year rule, the better off you are. So there's a couple of solutions there. What say you, Mr. Tim?
Yeah, look, both of those very important. But the other thing is just making certain, as well as this, that if it is in the spouse's name, you do the gift, you do the protector, and make certain the spouse is earning enough income or has enough separate cash to make those payments. Don't let, even if you did this and you're the risky person and their money goes towards paying home repayments, you know, I believe the ATO can still have a crack to say your money's gone towards something that is an asset that is somewhere. It just leaves yourself exposed. So I just like to have as many barriers up. Love the protector. Nathan in our office, I think there's 5 or 6 of these. We've got proposals out for this week. It just the numbers are just building and building all the time. Clients love it. One thing, sometimes the estate planning protectors build up in price. We've got a service for GPS members for quick fee that you can offer, so clients can pay it off over 12 months. Just be flexible with your how you want your clients to pay for that, but get them to agree to a proposal to make a good upfront payment, pay by credit card or pay by quick fee.
Yeah, it's again, so where we are with the protector at the moment, it's not static. I mean, most of the product out there you see from, look, as I said, you can Google gift loan back and you'll see around about 20 legal firms offering it. And look, a lot of your clients will go down to their local solicitor and they'll, you know, the solicitor will say, oh no, I don't believe you can do it. The reason they say that is because obviously you're taking it out of the estate planning sphere for them, which is their area of comfort. But when we go through it, as I said before, we did a deep dive on it last week. If you haven't looked at it, go up to the Lighty Docs Strategy Centre and you'll see the deep dive on Protector where we went through all the cases on it. One of the things that popped out of this case, and it was also raised to me just recently as well, is that, as they've said there, is that the husband has an equitable interest in that property. So when we have a look at it, a property, and I remember doing an article, in fact, I did a presentation to about 500 people, I think, when CGT first came out, because we had a look at the difference between equitable title and legal title. So basically, when you sell a home, when you exchange contracts, at that point in time, the purchaser has an equitable interest in that home. And as a consequence of that, although the legal title is held by the vendor, the equitable interest means that if the vendor decides not to go ahead because the market's rising, you can, as the purchaser, use specific performance to force them into that because of your equitable interest. So the effectively carves itself out. One of the areas that I'm looking at in some instances is that instead of gifting over by way of a promissory note, that we can gift cash, for example, here in terms of the promissory note by way of the car or share portfolio, but maybe actually transferring the equitable interest in the home over to that family protection trust. Now, I'm going to have to think about how that works, but I have seen it done. And the important thing about it is there's no stamp duty on transferring equitable interests. It's only where you have the legal title. With CGT, it may create an issue there, but obviously if it's a principal place of residence exemption, you're not going to have a CGT issue there, although you are carving out quite a separate element. So that to me is probably another option that we can have a look at when we go down with the protector. A couple of things that we've got there is, again, certainly not in the change GPS model, which is more of a what I would believe is a closing sales letter. I think Tim would probably say that. But we've got videos and also this client booklet on the guide to protecting family wealth. If you want, you can access that booklet and it can be white labeled in your name as well. So if you want to do that, just have a chat with our team and take it from there. So that's, again, just going back, my preference is probably jump on it. I'd use the protector personally. But if not, if you just want to leave as is, do that deed of ratification, deed of confirmation with a letter of advice, and also a deed of gift as well to evidence it, because that'll give you a lot stronger. With a caveat, as Tim said, that if the money has gone over. So it's a completely different world we're living in, but changes happen, and this won't be the only one that we've got. Any comments from you, Mr. Tim, while I just go through some of these questions?
Look, that's the key thing, just to get the right head and around the fact that we need to let our clients know about these changes. In fact, I've just been noting down here, I'm going to create a change GPS document for the end of the year for members to use 5 key changes you need to be aware of to give their clients to get ready for 2022. And that'll be, the home and the spouse's name, successor director, and I'll choose 3 others, and we'll give you the tools to be able to get this out there.
Fantastic. Got a question from John Stead. If real property is held in a testamentary trust, so that's like the family protection, is the TT enough protection of the assets for a business owner who's the beneficiary of the TT, that is, lives in the real property? Absolutely. So again, just going back, John, it's important to ensure that we have the relevant documentation so that if the beneficiary does live in the real property or lives in the property, make sure there's a lease there, and that can be offset by obviously distributions, etc. I think that's absolutely crucial. But again, just watch out for the testamentary trust. You'll need to really have it more the leading member style trust. If you've got an existing testamentary trust on foot, you can always upgrade that to a leading member style trust, which would also protect in terms of shares and succession planning. Again, it's better to have more than less. Good question from Chris Peristoridis. Where do we stand with Div 7A loans in the case of promissory notes? A Div 7A, well, a promissory note is a finance. It's the equivalent to a cheque. So you've got to be careful on that if you are paying out distributions from a company by way of a promissory note. But in this instance, if they're just individuals transferring monies over into the trust by way of a promissory note, obviously that's not a Div 7A issue. We may have instances, of course, if it was a company gifting over, obviously that would be caught with Div 7A.
Interesting on that, Grant, a company-to-company transfer of the promissory note is not caught by Div 7A.
No, no.
Company-to-company loans. So to resolve into loan accounts and things like that, you could use some promissory notes and you can sort things out. That's a different topic for 2022, but that's something we've been exploring.
Another one on that one, while you've been going through that company, because I know you're a great user of having holding companies between the two, so you can have one that's a finance vehicle and you can massage money between the two that's not caught by Div 7A. Do you want to, just for those people who aren't changed GPS or heard it, do you want to just go through that strategy?
Yeah, so, and we get it all the time. You might have a company with shares held by mum and dad, or even a discretionary trust. It's a trading entity, and it's got, sometimes millions of dollars retained profits. Wrong. Like that's like leaving the front door to your house open and putting all your money on the front table, ready to be taken. So the way, and Look, I mentioned a couple of weeks ago, we're actually building out a tax advice app that'll be a new app available on a new subscription for GPS members, hopefully by the middle of next year. And we'll have the 15 key things that you can do for your clients. And this will be one of them. So we'll give you the report that you can use for your clients and tailor to give this advice out quickly. Because we normally charge $1,000 or $1,500 for this advice, and you'll be able to do it in 5 minutes once we've got this app done.
Fantastic.
What you do, yeah, I'm really looking forward to it. The few other surprises we've got coming up next year as well along the tax advice area, but it'll go well with the estate planning apps we're building as well. But what we do is we interpose a holding company between the trading company and the end shareholders. Now, there's no CGT because the beneficial owners are the same. Okay, what you can then do is you can pay a dividend down from the trading company to the holding entity.
Yeah.
Now, the only thing to be aware of is the trading company, you might be on a base rate of 25 or 26%. The holding company is generally going to be 30%. So there might be a little bit of top-up tax. A little bit of top-up tax is okay to protect that money. And then you can just loan the money back, company to company. It's not a Div 7A loan, but you can loan it back, get some PPSR registrations on it and protect it. I love that strategy.
Yeah, no, it's good. I've seen a few in action, and it's been it's a great idea because you don't want to get any monies caught up in that trading company because, again, it's obviously it's a structure that is exposed, and we hate exposed structures.
Yeah.
Here's a good one from Rowan, is that how does this affect, where we do a protector, affect the client using equity to purchase future assets requiring lending? In that one, I'll give my bit and then Tim can have his bit, is that we obviously do a registered mortgage, goes over. That just simply evidences the fact that there's a loan there. It doesn't talk about the amount of the loan, obviously. So whether the bank requests to see what other loans there are, generally the bank is going to have the first mortgage anyway. And if you've got a first mortgage using the protector and you want the asset there for the bank to log into, they're going to want a deed of priority and to take the first mortgage, definitely. You can always go through position. You'll find up on the Like You Doc side to wind back that loan. So again, you can forgive that loan back to the borrower because it's not a commercial issue. Then effectively there's not going to be any tax there. But what say you, Tim?
Yeah, look, looked at this a number of times. Again, if you need to use equity there on that property, you just got to let the bank know, adjust the amount of the security, and then it's still protected because the equity is being used for something else. But then you want to use a protector on the equity on the second property. So you kind of move equity from one to another. You adjust this one and get another. You know, it depends if it's a risky thing that you want to protect or not. The second property might be in a if it's not a family home, it might be in a discretionary trust, which is protected anyway. So, yeah. Perfect.
Brian, how do you get the protector booklet? If you just contact our support team, just jump onto the Like Your Docs, the old site, which is now pretty ugly compared to the new one. But if you just go on, you've got the ability to have that white labeled as well. And there's about 3 or 4 other guides there as well. So if you want to have a look at those. Tim, this is from Rowan. How does the FPT, the Family Protection Trust, affect builders with QBCC and covenanters statements?
But that does affect that. So again, it's if you need to have an amount of equity to back up things for QBCC, what you need to do is make certain that QBCC has a priority amount or a specified amount. So that's when you talk with grant or eventum optimum and be able to work out how to structure that. You don't want to leave everything wide open for QBCC, but at the same time, yeah, it's just working out so you've got enough of that equity which you can prove.
Perfect. With Graham, are there any land tax penalties using the trust? Remember, in this instance, Graham, essentially what we've got here is we're only transferring the underlying value or the net worth of the property. The legal title is still in the client's name, which is why there's no penalties for land tax. There's no stamp duty, and also, obviously, there's no capital gains tax issues as well. This is an interesting one from, obviously, Josh. Interposing a company resets the 15 years for the small business exemption. So that's obviously a potential issue. But
just to say with that is you got to think about if you've got a couple of $1 million of retained earnings as opposed to a potentially different situation for being taxed, in 10 years' time, for argument's sake. I'd rather, give the client the option, obviously, but my big thing is to protect what you have. And because at the end of the day, even if you didn't take advantage of it's a big thing, depends what the value, depends what type of business it is, and whether it is a business of a type that could be sold that you take advantage of that. If it's a doctor's practice that doesn't have a lot of goodwill, for argument's sake, or there's a whole range of other things that it might be a sort of saleable business where you don't need to take that into account. It's more about protecting what you've got at the moment. So good point. We've got to look at the big picture.
Yeah, and I think there's another one we should probably in the early new year come and do a session on the business protector and start looking at where you've got those trading trusts or trading companies stripping out the assets and using, if you can, the CGT small business concessions and then leasing them back, which again gives us that other layer of protection. And it's quite interesting that a lot of the issues we're looking at are not really tax issues. So what we're doing is we're focusing on that asset protection and that estate planning. As I said before, Bosanac can have potential disastrous consequences for any estate planning. Jeff Wayne has asked a really good question before. Does Consolidated Tax Group overcome Tim's observations about 25 versus the 30 rate?
I'm uncertain. I have not done a lot of work in tax consolidations. No. So, look, I can't answer the question. I apologise.
Yeah, it's a pity we don't have Michael here. He's pretty good at that one. Yeah. Anyway, that's we're just over time. Sorry to run a little bit further. We've given you a couple of methods of rectification. We'll follow up with an email with a recording of this. As I said before, just make sure if you're in the 2nd December, 3rd of December, you're going to come and have a chat, aren't you, at least in Brisbane as well, Tim?
I'm definitely going to be in Brisbane. I might be able to make Gold Coast, but what am I talking about, Grant, in Brisbane?
Okay. Oh, well, I just think the stuff that we've been working on, change GPS, things that are coming up there, showing a couple of your goods and wares, which would be fantastic.
I might show a few sneak previews of a few things if you're in Brisbane.
Yeah, so I'm going to come up with, in fact, I'm going to come up with my top strategies, which are mainly succession, asset protection, estate planning. Maybe if you want to come up with 3 or 4 really good tax strategies for 2022.
I'll touch base with you over the weekend, Grant. We'll put some good stuff together.
Fantastic. And don't forget to register for the 2nd December, where Tim and I and the other board members will be launching the SEPEPA. And Tim and I'm number 1 and he's number 2 in the foundation membership. But we both know what the website looks like, and it's a bit of a cracker. So
yes, you'll love it, everybody.
Yeah, really. And the key theme there is leaving a legacy, which is something that's very aspirational for all of us, as is our clients. And our next SEPEPA course is from the 19th to 21st of January. If you want to get in contact with Light Year Docs, if you want to go along to that session and become a certified advisor, that'd be great. Anyway, thanks for jumping on, Tim. It's been great to have you, as is you.
Thanks for inviting me, Grant.
Erudite content. And I'll see you tomorrow for our planning day, which will be fantastic.
Yeah, look forward to that. We're catching up, Grant and I, Change CFS and Light Year Docs Group to plan for 2022, how we can help everyone out there.
Yeah, so also look at the long-term picture. So there's some very exciting trends that we believe are coming for all of you. So keep close and also keep us in mind. Well, it's Grant and Tim signing off.
See you everyone. Bye.